Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and we are blessed today to have two amazing guests, one of whom, Alan Patricof, is truly, one could say, one of the real godfathers of the venture capital and private equity industry. He founded his first venture fund, I think, in 1969. So we're talking 50 years of relevant experience. And everybody knows Apax, which he founded, which actually I believe stands for his initials of Alan Patricof Associates, and the X is Cross-Border something. Exactly. So we'll get Alan to confess about the name there, and then Greycroft. So Greycroft, I think it's an amazing story. I remember hearing that I knew Apax people, even Henrik Kraft, who was in the London office, then got into founding partner of KKR and is an LP in our fund. And I remember hearing in the news that Alan Patricof is leaving Apax to get back into early stage investing. And my research told me Fund One, Alan, was 75 million, but I thought I remember hearing you say in the news that 50 million would keep the fund with the fund size to be doing early stage investing.
Yeah, Primetime, we've started with 50 million.
With 50 million, okay.
But Greycroft did start with 75.
Okay, so I'll stop talking in a minute, but most recently, Alan teamed up with Abby Miller Levy to launch Primetime Partners, which is focused on investing in companies relevant to older people. So to get more, enjoy more out of life in older years, but I'll let you guys explain it. So thanks so much for joining. More recently, Alan joined forces with Abby Miller Levy. Abby began her career at, Harvard, Princeton, then McKinsey, and she more recently was the founding president alongside CEO Ariana from Huffington at Thrive Global, a behavior change technology company focused on employee productivity, wellness, and worked also with new ventures in Soul Cycle. So I'm really excited to hear about Primetime Partners and this unique strategy and yet another fund for Alan Patricof. So welcome.
Thank you.
Thank you, Andrew.
Got all your facts right. So I'll let Abby take it from here.
Okay, so
yes.
So Abby, maybe walk us through what is the thesis for Primetime, and when it was about 2-3 years ago, I think, that you and Alan really got going on this.
Absolutely. And thank you, Andrew, for having us. The thesis for Primetime is quite straightforward, which is that older adults comprise about 25% of the US and the global population. Is the fastest growing demographic, and control 2/3 of the net worth and about 3/4 of the healthcare spend, a super relevant and important segment of our population and society. But historically, entrepreneurs have really not been designing for this audience. In fact, the number of startups that have kind of gotten to later stage funding that focus on this audience, you can kind of count on two hands historically. So about 2 years ago, actually a little over 2 years ago, in November of 2019, I was telling my friend John Patricof that I wanted to start a venture fund to encourage entrepreneurs to invest in the space. And he dropped his fork. We were having brunch on the Upper East Side. He dropped his fork and said, "My gosh, that's what my dad wants to do." And so it was really this fateful moment in November of 2019 when Alan and I connected to start, working on Primetime Partners. I was fortunate enough to already know Alan. Alan, through Greycroft, was an investor and a board advisory member at Thrive Global, the company that you mentioned, where I was the founding president alongside Ariana Huffington. So I'd known Alan professionally, so it was actually quite easy, the camaraderie and relationship and trust that we had with one another to focus on building this. As luck would have it, we were ready to start fundraising and begin the process of launching Primetime in March of 2020. And as you know, the world melted down in March of 2020, really shut down because of the spread of COVID. And so you might think that that's an awful time to launch a venture fund. It turned out to be a fantastic time for us to launch a venture fund, because for the first time in a long time, unfortunately, the whole world was focused on thinking about older adults. You couldn't open the newspaper or turn on the TV without talking about the plight of seniors in nursing homes. Now, while that's just a small portion of what we focus on the overall experience of older Americans age 50 plus. And so that's beyond, seniors and senior living. It's, the population that has a whole variety of needs around their health, their financial services, their housing, their consumer, their media, their products. So we address the overall experience. We've made 23 investments to date since we officially closed Fund 1 in October of 2020. And those investments are about 60% healthcare related, the rest split between fintech and consumer. So that's a bit of the overview of the fund. We are now 4 investment professionals with a team of people helping us around that. And I think Alan and I would both say it's the best time we've had in our careers.
Well, it sounds amazing. I can only imagine Alan now at his age would have some opinions and insight into some of the investments you're making there as well. We invested, I'll send it to you offline, but I don't know if you ever heard of Envoy America. It's a company we funded out of Arizona. Okay. Where they're doing like Uber. They're like Uber for people with Alzheimer's or elderly infirm that you can't just send a lift to pick someone up.
Yes, NEMT. We know the space well. We also made an investment in the sector.
Okay. Yeah. So do you guys find that, are you feeling a bit like a monopoly in the sector, or this is an area that venture firms cover, but they tend to be dealing with younger teams, tackling problems they understand as younger people? I mean, it's just a clear strategy, a niche to go after, but do you feel a bit, obviously you feel it's an underserved segment of the market?
You know, it's interesting. When we started, I had talked to a bunch of my friends in venture funds, and the quote unquote silver tsunami had been a bullet point on everyone in ventures kind of thematic lists, because the demographic shift is so, first of all, it's obvious and it's notable. And so I think it's more, not that we are the only ones looking at the space. I think we are the only ones focused on it across all the verticals. So there's healthcare funds that are interested in this, fintech funds, prop tech, consumer tech, that have a vertical lens. We have a horizontal lens. And the benefit of having a horizontal lens is that across our portfolio, what they can learn from one another in terms of acquisition, engagement, service models, it's just tremendous. And so we have our portco CEOs all wanting to meet each other. In fact, we're hosting an event in June for them, because they recognize that this is an evolving space. So I would also say that not that we're out of COVID, but through COVID, we've seen a lot more interest, both from investors, but also entrepreneurs, because the topic has been so pertinent and personal to everybody. And so the number of other investors who are honestly complaining about how much technology support they've had to provide their aging parents who, for the first time ever are Zooming or using telemedicine, it's just become personal to investors and to entrepreneurs. So we're seeing a lot more activity in the space, which we welcome. We're seeing tremendous collaboration. I mean, Alan's always been a collaborative investor. And I think his book coming out will represent that super well. And so have I. So, we'd love to work with other funds to support great founders.
Sure.
Abby, I mean, when you're a VC, go ahead, please.
I would say, Abby, thank you for the plug for my book, which is, since I'm going to take the lead, it's called No Red Lights, and it'll be officially out on May 3rd, but it's available for pre-sale now on Amazon. So if your listeners want to buy it, it's there to order in advance. But everything Abby's saying is I would compound her voice and her enthusiasm. I mean, this has really turned into be. That's why we only raised a limited fund to start with. We weren't sure, how big the market was, how fast we could become a thought leader. Abby and I both agreed on one thing, that we really wanted to become a thought leader in the space, which means speaking at podcasts like that, speaking at conferences. We've had so many invitations from this group or that group on aging, whether domestic or abroad, and every major university from Stanford and the West Coast to Harvard on the East Coast, to MIT, to the London School of Economics. Everybody is focused on longevity, and we all want to know, we all want to live longer. In fact, one of our investments is a chain. I hate to use the word chain. It's 20 longevity locations around the country where people go to find out what they can do to prevent these diseases, not after they got them, to prevent diabetes, to prevent Alzheimer's, to prevent PTSD, to prevent heart attacks, and what nutritional aspects to take. So that's just one of the 23 companies we've invested in. It's called Cenogenics.
Yeah, I mean, look, when you're a VC, you want to add value to the startup beyond just your check. And sometimes it's easier in one's individual network to make relevant introductions to the founders to help them grow their business. I can imagine you guys are beginning to bring more and more focused relationships that are going to become relevant to every one of these companies, of like, how do you access this demographic? Who are some of the partners you can bring in? So your June conference, I can totally see that being enormously value add. And Alan, I pre-ordered your book. And by the way, for people listening here, yeah, I'm an author too. And I'll put a link to the Amazon in the show notes that anyone can pick up this book. And so it's No Red Lights and Never Driving Alone, and talking about 50 years in the venture capital and private equity space. So I'm sure there's a ton of great stuff in there. And listen, I'd like to talk about this on the podcast, but I want to make sure that we give time and attention to Primetime, the new fund. So Alan, what did you and Abby, what did you guys think was the right size for the new fund to get started with? I think that the Greycroft fund seems to have matured around 360, 380 million for a seed fund that's doing what, 100K to $5 million checks, and then the growth fund writing up to $50 million checks. That seemed to be like the steady state of where Greycroft on the venture side landed. What is your thinking around Primetime for now? You've already indicated that you wanted to test how big the market was, but I think the test is going to come back positive that the market's there.
Well, we're right in the midst of discussing, and I'll let Abby comment, and trying to figure out what Fund 2 will look like, what size it would be, because we really don't want to get ahead of our skis. And we want to right size it appropriately and not be forced to invest more than is appropriate in a particular deal. And that's one of the problems with a lot of the venture firms today, as you, I'm sure, would acknowledge. They have too much money and they overfinance and in the process raise valuations to extraordinary levels. We are trying to be responsible and disciplined. And while we want to invest the money, we want to invest it wisely and in appropriate amounts at valuations where we can make a venture return.
Right. Well, that's the voice of wisdom ringing in a market with what feels like lacking in wisdom. So maybe segue on that to talk about, what has changed over these 50 years, Alan, in your investing experience, and like maybe what's good and what's bad. I mean, you just kind of talked about funds getting too big, result in bigger check sizes, which can impact valuations, maybe premature spending and not as much austerity on a smaller check. But give us some context from 1969 until today with your first. It was 69 was your first fund, right?
Well, December 69. I set 1970, but you're very accurate. I get asked this all the time. I don't think that much has changed, except that we were all relatively unskilled at making investments. We were learning as we were doing it. There was no National Venture Capital Association, and I think at that time it was more going out and finding a deal rather than the deals weren't coming to us. Today, the deals come to us. No, I shouldn't say that. We're out hunting and pecking also, but it's a much more established industry. The people in it have all gone to business school. In those days, they hadn't all gone to business school, so they're now financially trained. It's the supply, the whole technology and entrepreneurial excitement of the last, I don't want to say 50 years, but certainly, it just keeps getting better and better and better. And there are more people starting companies. If you go to speak at a business school today, and I'm not sure I like the idea, but probably if you ask how many people want to start your own company, probably 70 or 80% of the people raise their hand. Now, they don't have necessarily the passion for a particular area. They don't have the experience in the area. They just know they want to start a business. And why? Because their best friend did one and he made, umpteen $1 million. I think that Abby could comment on what the market is like today without necessarily contrasting with what it was like then. Because the type of portfolio you had then was a conglomerate, a mishmash of different activities. You couldn't have started Primetime Partners in 1970. I mean, it would have been so no one would have known what you were talking about. And to be singularly focused in one silo would have seemed insane. But I think Abby can probably give you a good sense of what the environment is like at the moment, what we're experiencing.
So Abby, where's the market from maybe even like pre-COVID summer of last year to a bit cooling off? Where do you see valuations, how much money people are raising?
Absolutely. I mean, it's interesting because we go across the different industry sectors. So, digital health and health tech in general has been leading that, and, Bitcoin have been leading the venture world over the past 2 years because of the dislocation in our healthcare system and all the changes that COVID has triggered, as well as entrepreneurs realizing, wow, the system's really broken. I have an idea to fix it. So the sheer number and amount of the sheer number of startups, and then the amount of funding and the valuations within digital health is unprecedented. I don't think it's a blip. I think this is here to stay because fundamentally consumption is changing, and the shift from incumbents to startups is really apparent. So I would say a couple of things. One is just there's a lot of people starting businesses, to Alan's point. But within healthcare, it's definitely on fire. Fintech, we also invest in fintech. That has seen tremendous growth. Fewer companies are getting big, but big, very big. But at the flip side, the consumer hasn't been growing over the past 2 years in the same way, obviously consumer and retail. So it's just an interesting focus on those areas. The other thing I'll say, especially as a female fund manager, is the number of GPs. I mean, there are thousands of new GPs and new venture funds. And a lot of them, compared to historically, are being started by women. And I think that's a wonderful, to see that. I also think that because there's so much LP capital out there, you're seeing a lot of fund managers being able to raise, $50, $100 million funds for venture. So that is flooding the system with a lot of venture money. So it's not just proliferation of entrepreneurs, it's proliferation of funds.
Yeah.
One of the interesting things we've noted, and I don't want to say shocked, that's too strong a word, but really surprised by, is the number of companies that we've seen started by young people who are starting them because someone that they're related to or involved with, whether it's mother, father, grandmother, brother, sister, has had some problem that they've recognized has to be served. And so there are, in this particular area, we're seeing a lot of young entrepreneurs. Now, at the same time, one of the things Primetime has stood for is that our door is open. Our reception room has seats, older entrepreneurs who want to go back into whatever business they were in before, not necessarily serving older people, but if they were in the paint business, they want to go back and paint. If they were in carpeting, they can go to carpeting. If they were in technology, and they can start all over again rather than after they've sold their company or they think they want to retire at age 60. We're saying our shingle says, come and see us if you want to start again and if you can attract people from your previous company. We're trying to induce it, but even without that, Abby, what's the number of older entrepreneurs we have in our portfolio out of 23? What is it now?
I wish it was more, but 4 of our founding CEOs founded the businesses over the age of 50, which would be great if we can definitely have more entrepreneurs who are excited in their second or third chapter, using Alan as the role model of somebody who can continue to start businesses at any age. So it's definitely an area of interest of ours.
Well, it's not obvious to everyone, but it was obvious to me. I founded a company in 1995, and there was this guy, Ed Braniff, was the CFO of AT&T Systems and Billing, which was 70% of their revenue. And he took an early retirement package. And at the age of 54, he had a totally low, high risk profile that for him, he had a pension to live on for the rest of his life from AT&T. Mm-hmm. And I remember sitting down with Phil, my co-founder, and Ed saying, Ed, how long can you go without a salary? So, this is early days of the startup. And he goes, probably a couple of years, and we were like, well, you're hired. And so it's interesting that you think of startups as a young man's game, which is now becoming a young woman's game, thank God, maybe late than where it should have been. But some of these older people have a profile that they can totally go down the path of uncertainty of how long it takes to thrive, as opposed to that person's got 3 kids in private school, cannot just go off to Y Combinator and live on nothing for 18 months. So it's maybe a little less obvious than it would seem, but it's there.
I wonder how many, that's an interesting question. I wonder how many older people, let's say over 50 or over 60, go to Y Combinator. I wonder if there are any. I have no idea.
I've not seen any, and I try not to miss a demo day. So it's interesting to think, right in front of my face, Ed's story made it really obvious that he was ready to join a startup. And after a life of, he ran the Yellow Pages with Joe Naccio, just an amazing career at AT&T, and now making a shift. Another thing to talk about here is if you were talking about these days, raise your hand if you want to start a company. If you go to University of Tokyo today and say the top of the class, what is your first choice career path? It's amazing how many say, I want to work in the government, which you're not going to see in the United States. And then the next choice is big corporates, or just massive, they want to work for a huge Sumitomo type company. And how many want to work for startups? Not so many. These days, you ask young people, what's your, first, second career path? Sadly, you'll hear influencer, which, makes me sick. They just want to be a YouTuber or something, but they all want to be Mark Zuckerberg. They think they're going to get rich quick and it's going to be not so much of a grind, but it's just a totally different shift in the population from like where the US is now to where Japan is. And you can probably expect that to change, around the world, But I would think other big shifts too, Alan. I remember in the 90s, if somebody got an IPO on the NASDAQ with a 350 million market cap, that was considered pretty damn good in success. That was the winner circle. Whereas now you're seeing with bigger funds and post.com crash, Sarbanes-Oxley, companies stay private forever. And a 350 million pre-money valuation for a company that you're 4 years into doesn't even seem that big. What's your perspective on these sort of changes to the landscape?
Well, clearly not for us at Primetime at this point, fortunately. But speaking to Greycroft for its new fund, which is just in the process of raising, has set as an objective, they set 4 pillars now, 4 silos of areas they're going to focus. And they really are not interested in any company that doesn't have an expectation of a $10 billion exit. At first, it seemed extraordinary to me, but they may not be wrong, because I think a lot of these companies are getting to very high valuations in a very quick order at multiples of something. I don't know whether it's multiples of the hereafter. It's certainly not multiples of earnings. It's maybe multiples of revenues. Maybe it's multiples of people employed. But
okay.
I think the whole level of expectation, and if you think about it, it's circular. It's got to be that way. If you're going to raise $1 billion fund and you're going to put $50 into a deal, it better have a big exit, or you're not going to make the kind of, because you're not going to own 100%, you've got to own a fraction. It's better to have a big exit. Fortunately, with the size of fund that we have at Primetime, and that we will probably have, I'm sure it will be bigger, but not too big. We can realistically put reasonable amounts of money at reasonable valuations and have realistic exit potentials.
Right. I like the Primetime a lot more than this modern Greycroft view. I hear for the first time in the last year, entrepreneurs that were pitching me for funding would say totally deadpan faced, so I completely believe this is going to be a multi-trillion-dollar company. And I'm like, well, it better be for this stupid valuation that you're running around with, which is not so interested in me. And I'm not convinced that there's more than, you have Apple, Microsoft are hitting multi-trillion. But that is a shift in the industry, that we do have companies with more than $2 trillion valuations out there, that there are $1 trillion valuations. And then there's a sea of these decacorns. So that's your 10 billion aspiring Greycroft exit that can start to buy companies.
My partners at Greycroft are not dumb. They're actually very smart. And I think, and we've had several exits that reach that level. And, with some of the markets that are now developing and the fast growth in these companies, I'm sure they're going to find more than they need to justify putting the money to work.
Sure. Well, I hope that happens with Crafty. I invested in Crafty, and then Greycroft invested with us a few weeks ago into their last financing. And so I'd be delighted to see that become a decacorn. But if it doesn't, we can still make a 50x return on it. So guys, with 50 years of experience and partnering with Abby on a new fund, a relatively new fund, what is your expectation on a cash on cash return when you're going into an investment? So when you guys are funding a company and you're being realistic on entry point valuation, dilution you're going to take, follow on investing, what's the expectation on an individual return going into it?
Well, I obviously can answer that, but I'll let Abby answer it. She
Okay.
can she'll give you the modern version. That's the beauty of our relationship, is that, the blend of 50 years experience with someone who is extremely smart. You don't know Abby, but she's a superstar, and she knows what she's doing. She's not wide-eyed and dreams of things unrealistically, but her perspective is perhaps more reflective of current environments. So Abby, you can comment, and I'll.
Well, Andrew, just to be data driven, of our 23 investment memos, the exit analysis return is ranged from 4x to 15x. And I think that is representative of the fact that we invest across sectors. So we'll invest across services businesses that serve older adults, which are typically lower return businesses, to SaaS businesses, which are higher multiples. And I think the reason that we're comfortable with that range is that it's more than just an exit number. There's other variables at play in terms of time to exit and the time value of money, certainty of exit, and then the strategic value that it provides to the portfolio. One of the things that you'll hear from many kind of fund one managers is fund one typically has more investments in it with smaller checks than funds 2 and 3, because you, as in fund one, are really understanding the landscape, making sure you're building your network and getting in the deals you want to get in. And I think that is representative of our fund. I mean, our first fund will end up with close to 35 investments in it. And so, that is, will be refined as we go into fund 2. So to answer your question, I think it's also a little bit of a silly analysis and a silly question, because every investor wants to start out with 15x in their investment memos, and this is garbage in, garbage out. So I typically, when people ask me this question, I say, I'll let you know in 2 to 4 years, what the actual is, not the forecast.
Well, at the same time, if someone, if if a company with 1 million of ARR just breaking 100K monthly recurring revenue is seeking a 70 million pre-money valuation, or even imposing a convertible note, which will even be worse for the investor in most cases like that. If it's 70 million pre and it sells for 700 million with no funding between now and then, you're looking at a 10x return. And at that stage of traction, I kind of think that there should be potential for a 50 to 75x, on investing early. So we kind of look at what is the entry point valuation and what is realistic with taking dilution, or our next investment will be investing at a higher valuation. What stage are you investing in? So with these
we're pre-seed, seed, and Series A. We're pretty evenly split between seed and Series A, with 1B sneaking in there.
Okay. And so what's the range of valuations that you're seeing in the market right now? And has that been cooling off for you, or has it been heating up in these fast moving, highly sought after financings?
I would say it's all over, certainly sub 100. But I want to go back to answer your question. Abby can then comment as well. And in terms of your question that I threw to Abby, I'll take it back. In terms of what, for me, my expectation is if you're going into a high risk situation with no revenues, you should be if you want to stay in the venture business a long time, you should be expecting at least 10, 15, 20 times on your money at that. That's balanced by something that already has some proven results, and that is, may have revenues and may have a product that's already developed, in which you realistically scale back your expectations, to perhaps even under 10, but certainly 5 to 10 times.
Right.
I would hope that we don't have too many returns that are less than 4 or 5 times on our money at the worst, and that depends on what stage you're at. I will say something else, which is I keep saying to Abby, and because of my long perspective and long experience in this market, I am incredibly impressed by the state of our portfolio, and we're not selling. We're not raising money now, so I can say it. If I was raising money, I wouldn't say it. But out of our 23 companies, so far, I keep my fingers crossed, we've had no write-offs yet. I'm sure there will be. And we've had 6 or 7 companies that have done subsequent rounds at markups that we did not have to lead. So we weren't forced to participate to justify getting other people in, which is pretty good for a company that's focused on seeds, pre-seed, seed, and A round. So our portfolio is in pretty good shape. And I think we can, it's a blend, because we have some really early stuff and a little bit later stuff. And, listen, what venture returns are. No matter what you say, almost every fund, except for ones that are, have something extraordinary from one company, end up, 3 times on a venture fund, usually ends up pretty good net of the losses. I hope we can do that or better, frankly, overall, reflecting losses after expenses, net of GPP's interest. I would hope we can end up.
And what's your, I actually wanted to ask you that question and you just gave me the answer, but sometimes I think as an emerging manager myself, I'm investing out of a fund 3 right now we actually think we can make 12 to 15x on our early stuff. But sometimes I think if you were investing later stage and you're returning a 3x, but every 3 years, it's returning a 3x 3 times over 3 different vintages in a 10-year period, as opposed to these early ones that have taken so long to really fully get distributions. So the TVPI, the total value to paid in, is great with all the markups. And we're at above a 4x, and we think it'll land between 7 to 15 for fund 1 and 2. But I think we should be selling some of our position in some of those companies to our own SPVs to return the fund a bit faster, because making a smaller multiple, but it happens quickly, is interesting compared to making a killer multiple, but it took so damn long. Hopefully one of your portfolio companies will let me live longer, but I'm already looking at how damn long does it take, to get out of these. So maybe what's your perspective on, because you've got the Apax and the Greycroft and the early, what's your perspective on making those shorter multiples late versus early, and where to meet in the middle?
It's always a trade-off, but I'll just remember something, not remember, I will remind you of something I've been saying for years. You make your most money on the last double. So just keep that in mind, and that may help you when you're thinking about whether you want to stay longer.
So when you say you make your most money in your last double, that means you're at a 25x or a 50x, and then all of a sudden it doubles from here. Is that what you mean?
If you went in at 1 million and it's worth 10 million, and you along the way you've made money, but if it goes from 10 million to 20 million, in absolute dollars, you're making more money in that last double.
Right.
And,
Right.
Yeah, and obviously time comes into play. But just remember one thing also, I have usually the oldest person in the room, and I have the longest time perspective.
Well, I don't know about that. Being a combination of being smart and having the experience and having been around is worth a lot, I think, in any room.
Well, what I'm saying is I'm not rushing to sell things. If they have running room and they have momentum, stay with it.
So ride your winners. Right. And I think we might be running out of time. Alan, can you give us one or two nuggets from No Red Lights, so the all green light book that we can pre-order now?
Well, I just gave you one, which is focus on the last double. The second I'll tell you is don't count on a cascade of miracles and think everything is just going to go in the right way. It just doesn't. Unfortunately, revenues and multiples and margins and profits and everything else, they all don't go the same time. Some exogenous factor always seems to interfere with one or more elements of a business, and you just have to be prepared for it.
Yeah, I think diversification is a good way to neutralize that singular risk, because that stuff is going to happen to every roller coaster startup. And guys, if VCs and founders want to reach out to you with deal flow or LP interest or anything, what's the best way for them to get in touch with you?
hello@primetimepartners.com.
Okay, hello@primetimepartners.com. I'll put that in the show notes along with the link to the new book on Amazon. Well, Alan, I can't wait to read your book. It'll be right on my bookshelf behind me. And look forward to collaborating with you guys on deal flow. And if we get into a decacorn, that's great, but we don't need it to make some good solid returns.
Awesome. Great to see you, Andrew. Thanks for the time.
Okay, Abby, see you soon. Thank you so much. Bye.